Good evening to you. Thank you very much to the Caribbean Association of Banks, and good evening to all those who would have joined us this evening. And today I'm going to give you some useful, very useful, I'm thinking, information for making decisions about when and how to invest for retirement. Understanding and implementing the right steps to invest when indeed you're preparing for retirement is critical, just to ensure that we know and we are helped in our decision making for having money after retirement. In fact, not having money after retirement is a tragedy that hardworking employees will face if we fail to prepare for our retirement, if we fail to plan, and if we fail to take steps as early as we possibly can. Taking steps early could mean even as of today from this webinar. And so today we think it's very important because in times like these where COVID, as an example, is bringing on certain situations in the economies, we know that we are really in dire straits as far as preparing for tomorrow is concerned. Our investments are losing value, as an example. And so we want today to work through in this webinar, with thanks to everyone for joining, investment for retirement, some points that will assist us in making our investment decisions when we decide to revise what we have, or when we decide to start what we are undertaking for retirement. Investing money regularly in the present will significantly change the way you live life in the future. This, in fact, is a statement accredited to someone else, but it is important for us as we go forward. Just before we go too deep into it, let's just make sure that the webinar is for you and that what we're going to put forward is going to be useful. So I think this will be useful to you if you want to take control of your retirement, but you feel like you are sort of stuck and lagging behind right now. If you are worried about retirement savings not being enough and you want to look to investments to pump it up or to ramp it up, and if you've heard of investing, but you know it's important, but you're wondering what you should be doing at this stage of your journey, then this webinar might be for you. And in fact, we can think also that if you want to grow your money faster and not suffer losses, then you are looking not to be anxious, not to be uncertain about your journey towards retirement. In that case, this webinar is for you, and I'm very glad that you have joined us and found the time to be with us here for this session. Quick disclaimer, real quick, and that this webinar is for education and awareness purposes. I am not going to give you specific recommendations and specific investment advice. Illustrations and examples that I give are for information and training purposes only. And so we are not salespeople here, and we are not your financial advisors. I'm not your financial planner. I'm not your securities broker. For specifics, you need to go to your investment brokers, your securities brokers, and so. Surely though, if you are determined to learn and to really look at the experience of others, then no one can stop you from learning. And we will give you a great deal of information during our next few minutes together. A key element to retirement planning, and I guess you know that why you are here, is to look at your investments. Retirement is broad, investment is just a component of it. And this investment does not involve simply adding money to your bank account or adding money to your pension fund. I can ask a few questions, really. Does your current investment allocation match your risk tolerance? How often do you review the allocation that you have right now in investments, if you do? And how often do you make changes to that allocation in your investment plan? Are you aware of fees and the charges, some of which may be hidden on your brokerage accounts or in your investment vehicles, even your bank accounts where you invest in CDs, etc., and the impact that those can have, adverse in most cases, on your retirement monies? Are you prepared for a fall in the financial markets as we are anticipating in the aftermath of COVID, a fall in rates as we witness continuing here? And what investment strategy or strategies that you have in place, whether on your own or with your advisors, to ensure that you protect your money? I mean, these are some hurdles, investment planning hurdles, for those of us who are looking towards retirement. They are hurdles which stop us from getting to our goals. And that's why this webinar and webinars like these are important, especially where we get the information out of the goodness of our providers or the support of those who have gone through difficulties before. But first things first, investors should consider the investment objectives, the risks, the charges and expenses or fees of investment brokers, of investment companies carefully before investing, always. These and other information will be found in things like the prospectuses, or if there's not a prospectus, there will be a detailed information sheet about the investment. If ever you are presented with an investment and there is not a prospectus or a detailed investment sheet where you can find what you need to know about that investment, think twice before investing. Perhaps think not to invest. You can obtain prospectuses from brokers, from financial representatives, even from banks that are interested in investments, and read this prospectus carefully before investing. We cannot stress that enough, especially for those of us investing for retirement. There is not a second chance as far as our retirement money is concerned. Properly speaking though, retirement action plans do not begin with investments. A preliminary stage of retirement planning will be our savings, and of that savings, our emergency provisions before we advance to serious levels of investing. Unfortunately though, many persons today are behind schedule when it comes to the retirement savings, and other persons do not have any retirement plans at all. But combined with the uncertainty of things like the corona aftermath, and coupled with situation in some countries with social security, even the shakiness of some employer sponsored pension plans, tell us that today more than ever, investment for retirement is really, really important. So that's why in this webinar, we're going to go through a few things, and I want us to look at risk tolerance, look at time horizon or investment horizon. We want to look at cash accounts and the role of cash in our investment planning, and we want to look at bonds. We can't look at everything in a brief seminar like this, a webinar like this, but we're going to look through these here. There are other retirement planning and investment for retirement planning topics that we should look at. For example, stocks, mutual funds, investment fees and expenses when we are making our placements, individually managed investment accounts, very, very important, and annuities. These are also very important, but we won't look at those today. I hope we can look at these in a future webinar. In this webinar, you can see, therefore, that we are going to look at key topics and the basics to investing for retirement. We are also going to be given ways to ensure best decisions are made and to let us know how we make those decisions for protecting and for growing our investment. We want to spend some time speaking about tolerance, a lot of that, and your risk tolerance level, and about your investment in long-term instruments, particularly bonds. Now, I will say this to you, that in the past couple of months, a few friends have been asking me questions like, how can I safeguard my money in this COVID scenario with crazy falling stock prices and looming financial hardships? How to ensure that I do not lose my money and that investment for retirement does not get lost in what is happening in the marketplace? Well, in fact, I actually do have a workshop, a special workshop, in which I teach people how to fix their retirement plans during periods like these. In that workshop, I help in small groups. I help you identify what must be gotten rid of now, what should be dumped, and what individuals and companies need to be invested in order to have enough money after retirement. Now, if you're interested in that workshop, I can give you some information and a link later on. So back to the matter of investment planning topics that we look at and becoming so important in these days. I'm giving you all of this information from the heart of my fresh experience, because I gladly took early retirement in March of this year. In the raging storm of COVID, transitioning from the corporate desk to this wonderful retirement style, starting out without fear, even in the midst of the pandemic. Before I go further, just for those who are not very familiar with me, yes, I actually am from a financial services background. I have been teaching finance and economics for quite some time. I got into investment banking by becoming an employee of a merchant bank. And before that, I was in the Ministry of Finance as a budget and planning officer. I was there as a controller of inland revenue. Then after that, I worked as a securities broker for several years in the Eastern Caribbean Securities market. And later on, I worked in the capital markets in Barbados for 11 years until I took early retirement this year. I worked as a senior manager, market operations of the Eastern Caribbean Securities Exchange. I have a law degree and also postgraduate diploma in financial policy from the University of London, a master's from the University of Havana, and I have a fellowship in the Institute of Canadian Bankers. I spend quite a bit of time these days, quite a lot of time I spend these days discussing retirement, personal financial planning, and I have friends in about 25 countries around the world. All we do these days is just like our game. We spend a lot of time speaking about these topics and seeing how we share information and share experiences. And everything I give you, everything I do in the teaching courses and in the workshops and in these seminars, they come perhaps 80% from my experience and training. Only maybe about 20% come from textbooks and so on. And that is just for good form and to make sure that we have as much as we can have from the theory and so. So in this workshop, you actually can rely on the information that we give you, because I'm not giving you something made up just for now. Glad that you are with me for it. And let's take the first topic, risk tolerance. Now, risk tolerance is a topic which is very important when it comes to investing for retirement. Critical to success in investing, but we often ignore it. We tend to ignore it especially while being too overzealous about getting higher returns. Now, as you approach and get closer to retirement, the aggressive investment products and allocations that you could have taken up in the early years of your career and working life, those may no longer be appropriate for you, because your number of years or working years are getting shorter and shorter. Risk tolerance is the amount of fluctuation, the amount of up and down in value that an investor can withstand. That is the amount of volatility, as we say, in the capital markets. An investor with high tolerance for risk can enjoy higher rates of return on their investment. But this will also mean that they will experience larger swings in the price movements of their investment. An investor with low tolerance of risk will earn comparably lower rates of return on their investment, but they will also enjoy or experience very little swing, very little volatility and up and down in the price movements of their investment. These are important considerations as we look at investing. So we often meet persons, who say that they are conservative. But when we take a quick look at their investment statements and portfolio, we find that they are still invested in company shares and high growth stocks and so on. I have friends in the diaspora, for example, who consider themselves conservative, but they are still invested in aggressive growth stock funds and companies out there. It is important to pay attention to having your investment decisions correspond to your risk tolerance. We cannot stress this too much. The lesson is that investing involves a lot of potential reward. That is true. And that is why we take webinars like these to heart and to help in others. If you want the higher rewards, you need to be prepared and willing to accept the higher risk. On the other hand, the other side of the coin, if you want to be investing for retirement but only exposed to lower risk, you need to accept lower rewards. That's what we say. So you need to find really an acceptable level of risk to you. On the capital markets, we say a manageable level of risk, one that you can comfortably walk around with. Did I say comfortable? And the point is yes. How do you know? How do you at least approximate your own manageable risk tolerance level? Because something for you tolerable would not be the same for another person, not the same for your broker and advisor. But how do you know what is your tolerable risk level? And what you do is that you ask yourself some very pointed questions. For example, how much money can I afford to lose? Will I worry a lot and will I lose sleep over an investment which is before me? Will I be able to act rationally if the investment price or the value suddenly falls? Or will I be going into an emotional panic and a frenzy? What about the investment? How much do I understand the investment? Now, this last question is really important. I remember asking, for example, a Bitcoin investor to explain to me what it is, how it works. And trust me, my friends, At that time, they had not developed the layman's explanation for it, and he found it quite difficult to tell me what it is. To understand an investment, you must know what it is. What are the risks? Who are the competitors in there? How is value added, and how can you determine the value that you have in that investment? A lot of friends heard of good things and it's good placement, very easy to make the investment, and they run and do it because of results others were having. Investing for retirement cannot tolerate that. Investing for retirement demands that you understand the investment product and understand it very well. I don't mean that your broker understands it. I don't mean that your advisor understands it and your accountant. I mean that you personally understand it. After all, it is you who will be living out in retirement. Another important element of knowing your manageable risk tolerance level is this question about the amount you can afford to lose. This lesson is that you should never invest more than you can afford to lose. Why? Because that is not investing, rather that is gambling. For example, if you have a good deal and you decide that you're going to take up some mortgage money that you have stored up for the payment 6 or 5 or 4 months down the road and put it into that investment with the hope that your investment will double or triple in the coming 4 or so months by the time you need it back. What you're doing there is setting up yourself for a disaster. That is gambling. It is not investing, because this factor, you cannot afford to lose that amount, which is already earmarked for the upcoming mortgage payment. If the invested amount is greater than what you can afford to lose, it means you are not investing, you are in fact gambling. Your face, I don't know these people, but this is the expression that I would expect to have on my face if I went into investments without knowing my proper risk tolerance level and without actually working through with what I can afford to lose only. I'm told that the great American investor and billionaire Warren Buffett says that investing properly should be boring. It should be lazy, bordering on sluggishness. So our thoughts when we are focusing on investing for retirement must not be in a direction of haste. It should not be in a rush, and it should not be without caution. Instead, we should work towards knowing and being comfortable. If you are getting too excited and too nervous, check yourself, because it means that you may be doing the wrong thing. You may be going about it the wrong way. Your risk tolerance level cannot accommodate it, and then you need to change. So again, a comfortable risk tolerance level for you should be when, after you invest, you can sleep without worry. You can go about your day without having any significant concerns about how the fluctuations in the market happening and whether things are up or down. You should not be worried about that when you have properly invested. One of the biggest killers of investment portfolio success is emotions. I must quickly mention that. This tends to run high, emotions, when your risk tolerance level is not manageable and is not comfortable for you. You are in fact perhaps carrying on somebody else's agenda who needs fees or who describes the thing nicely and draw you into it. What happens when emotions are not in check is that you are unable to take a step back and to make rational investment decisions. Investing for retirement requires rational decisions. Prices and value of investments will always go up, they will go down, they will go across sideways sometimes, and there will be no one able to explain to you the reason. Very often, you don't know why it happened and it's out of your control. Emotions in investing pushes us to act or to react based on impulse, based on fear, based on panic, and that leads to failure. We don't want to be there. So that was the topic, risk tolerance. Now we want to look at investment objectives. Knowing the goal, the purpose, the target is extremely important. Always assess this and to know it. What is the purpose for which you are investing, or the purpose for which you are going to place money in the investment that is brought to you at the moment? Are you looking for short-term gains? Are you looking for long-term growth? Are you looking for current income? Or are you looking for income drips while you are in retirement? Or perhaps you might be looking for a combination of income and also growth. Now, whichever one is your objective could be correct. There is no right or wrong objective. The point is to know it, okay? And that is straightforward. For if your objectives are not straight, then investing for retirement will likely be flawed, and that is a lesson there. The next topic of importance for investing for retirement is your time horizon. So you know your risk tolerance, you have your investment objectives clear, and now it's time to determine your investment horizon or your time horizon. This time horizon means the amount of time your money will be invested before you need it for your end goal, which tonight we are speaking about it being retirement. There could be intermediate goals as well. The time until you need the money to cover the expenses in retirement. So notice I'm not saying until your retirement date, but the time on which you will need the money. It could be 1 year, 10 year, 12 year after you would have retired, but that is what you're looking to build your time horizon. So some of your investments will be drawn out even after the period that you would have retired, because you are looking for income and you are looking for money in that period, not necessarily at the date of your retirement. We work all these details in the workshop that we have, the full retirement planning workshop with checklists and calculators and so on for your own specific situation. So that's what the time horizon is about. If you want your money if the money that you want to invest now is money that you will need for a down payment on a home, for example, within the next 9 months or 12 months, you think you will close the deal in 6 months, then your time horizon in this instance is short term. Generally, short term horizons would require you to take a very conservative investment product or a conservative investment plan. If you are nearing retirement right now, you need a conservative, fairly conservative plan. This is understandable because if you put the money in short-term CD, you will have that money there when you need it. But if you went and you placed that down payment money into a volatile company stock or shares, then the price may be lower than you pay right now when you need the money in 6 months' time. And you will have to sell it at a lower price, at a discount, and you would have taken back out less than what you would have put into that investment, all because you did not specify your time horizon to correspond with the investment that you were doing. What about the long term? If your time horizon is long term, such as, for example, planning for retirement, then that could allow you to take more risk and achieve potentially higher rates of return as well. If retirement is several years away for you, then investing for retirement is long term, your time horizon, and in such a case, your day-to-day fluctuation of investments that you enter would not be a problem, would not be of much concern to you, which means that from this viewpoint, your tolerance to risk would be yet higher. Every time I talk about time horizons and so on, I remember the story that I like to tell about my father. 27 years ago, my father, who was a career civil servant, he worked all his adult life as a government employee in the Ministry of Agriculture. He told me, he said, "Tarlie boy, prepare for your retirement years yourself. Do not depend on anyone else. Do not expect any government or anyone else to take care of you in your retirement years." And true enough, my friends, as I grew older, I watched my father transition from a dedicated small salaried employee into an entrepreneur and then a retiree. He owned his own pet shop, which he operated himself with a small staff, and he owned his own home free and clear. He was debt-free. He could spoil his children silly with money and gifts. And he spent most of his weekends in his hobby of dominoes and fish. In fact, at the age of 70, he even went and purchased a boat. At the age of about 70, it was 70, he purchased a boat so that he could progress his hobby on the seas. I tell you, that was not even from his retirement income. It was from an investment proceeds that he had received at that time. He had it in there just stacked up, and that is what he found to do with it at the time. He showed me a pathway to a comfortable life after retirement. Showed me, I say. Not many persons have a role model, the benefit of a role model in retirement planning. And so we find many persons 50 years, 60 years, they have not really prepared a plan. Even those who have prepared a plan, they do not review it. We do not update it from time to time. And worst of all, as my father warned, most people struggle with savings, not to mention investments, and find it very difficult and extremely hard to create and to stick to a retirement plan. That's why we take webinars like these and we take sessions, discussions like these to heart, where we can help persons in their investments, in their savings and so on, they're planning for retirement. Most of the time, these are just awareness seminars just to help persons to know that there are things you can do today to ensure small things that tomorrow you have money in retirement. And that's why in the full retirement workshop, we deal with a lot of worksheets, we deal with a lot of checklists, personal accounts, we look at that. We work on tightening up your investment decisions to protect yourself. We look at the prospects and the potential you have. In that workshop, I help you fix, in small groups, I help you fix your retirement plan, to identify the things that you need to get rid of now, and those things that companies and individuals need to get into in order to secure our retirement money. You can get a link to that later on. Let's take the other topic. Before we go there, current positions. What about current positions? I have to make this point real quick. Do not make new investments without looking at your current positions. For correct decisions and for best results, you need to consider your entire portfolio. You see, for example, if you're already heavily invested in company shares, like growth stocks or so, and you get a nice deal presented to you, before you add to that, you should look to see whether it makes sense, especially if you are under allocated in other investment or asset classes. So it will make no sense putting into more where you already have a lot. You cannot be lopsided. That is like putting all your eggs in one basket, no matter how good the deal is. Perhaps you substitute another, you bring in the new. But when I say look at your entire portfolio, what I mean is your pension plan, look at your mutual funds, look at the stock exchange holdings you have, bonds, any treasury bills, anything. Look at your full portfolio before you make any new investments. I want to go on to the topic of investment categories. We're still looking at investing for retirement. As an investor, you can invest your money in two ways: by loaning it to others with a promise for repayment to you at a specified time in the future, or you can invest by purchasing an asset without the promise of repayment to you. There is no promise to repay you, but with the hopes that that asset will increase in value, will appreciate over time. In this webinar, we'll be looking mostly at the loaning part, not so much of the asset purchase part, because I just want to get through to you with some of the things that you can use for investing when you're thinking about retirement. Before we go to the loaning part, let me just quickly, for completion, speak about the purchasing assets. Now, when you purchase assets, you become an owner in the asset that you purchase, right? And so the common examples of these are like real estate, when you buy a piece of property for investment, or when you buy stocks, when you buy shares in companies, public companies, or even private companies. When you buy stock funds, such as mutual funds and so, and when you invest in businesses, privately held businesses, what you are doing is that you're becoming owners of these businesses. And as an owner of assets, you will receive certain things. You do not receive it directly. You're not being promised that you'll receive back your money. You're not being promised exact interest rates. And what you are receiving is the potential that the assets will increase, and you will have capital gains, we call it. You will be able to have more than you would have put in. What you investing in is the potential to receive income in the form of profits and dividends. And you also, at the same time, I dare say, get the risk that these assets may not perform. Companies may not do as well as they used to do before you bought your shares. And so we find that these are the topics that you go through, the way in which you look at investing assets. But we're not dealing with shares and bonds today. At this time, we will deal with more the loan side of things. And we move over to that, looking at the investment category of lending. Now, the most common places you can loan your money are to governments, local governments, banks, corporations, and so forth. And you can be investing in companies that are publicly listed or companies that are not listed on any exchange. But these are the places where you can invest as far as lending is concerned. Here are some common examples of where you lend your money: in cash and cash equivalents, like repos, like commercial papers, treasury bills, treasury notes and bonds, the certificates of deposits, or corporate bonds. Yes, these are instruments in which you could invest. Now let us look at these instruments. When I say instruments, these are the things we call the things that you invest in instruments. So investments for retirement should be made with a long-term perspective, because they usually perform better over extended time. Some money in cash must be kept. We mentioned cash and cash equivalents. We teach in another webinar that in order to take care of unexpected expenses occurrences that happen from time to time and need us to jam out money, we should keep an emergency fund. This is normally held in readily available cash, very liquid. Again, drawing on the great American investor Warren Buffett, he says that cash is the riskiest asset class of all because this asset class does not keep pace with inflation ever. So what he means is that you will have the money hanging around at home or in the bank, and inflation will be going up, and the purchasing power of the money you hold will actually be going down. So you don't want to hold too much cash. The amount of cash you want to hold should be just enough so as you can take care of the things you need to take care, especially for emergency. That money must be reserved and should not be used for anything other than financial emergency. Doing so, when you put aside that emergency fund, it means that you limit the possibility of having to get into debt, having to get into serious debt when unexpected occurrences happen, right? An emergency fund, they say, generally should be 3 to 6 months. For us in the Caribbean, we're working out and we're realizing that to be really easy, it should be 6 to 9 months really. And COVID is actually teaching us that for a lot of persons who have had to face, employment situations with that pandemic in the air. Now, examples of cash and cash equivalent, we say our savings account, we say our money market accounts, even money market funds can be that, and short-term deposits as well, especially those just up to 3 months, not too much longer in series for your emergency funds. So some accounts like these, they have a lot of fees, so it's important to check with your providers to make sure you know what the fees are, because the higher the fees is the lower your real rate of return or your what we call your yield. Yeah. Okay. So now we should go over to the training as to bonds, and I wanted to spend a bit of time on bonds because bonds are long-term instruments that are well suited to investing for retirement. A bond is a debt obligation of the bondholder, of the issuer, the bond issuer. That is like the bank, the company, or the government, they issue bonds. And this obligation is to the bondholder, the investor, that is you and me. And just like mortgages on a home, and just like credit card payments, these bonds give repayment on it. They are loans in the true sense of the word, which we are lending the companies, the government, the banks, and when we buy the bonds, and they are paying us periodic interest as well, and eventually they pay us back our principal. So that's what a bond is, and you need to know some key terms about bond and investing for retirement. Bond being suited, we need to know some of these terms. Face value is one of them. Face value, which is sometimes called par value, it is the amount which the bond is sold for, and if you bought it for initially, you buy it at that value, the face value or the par value, and that is the same amount that will be returned to you after the maturity of the bond or at the maturity. Next, coupon rate. The coupon rate is the stated interest rate. So when a bond is sold to us, a treasury bill or anything like that is sold to us, that loan is just like they tell us what our interest on our loan is when we take it out of the bank. The coupon rate is the interest that we will be paid, is the stated interest, the rate paid on the bond. It is nothing to do with the price of the bond, nothing to do with the yield on the bond. So now we go to what is yield. Yield is the annual percentage rate of return on the investment. That is what it is worth to you. What is the value of this investment to you? What is the value of this bond? That is the yield. It sounds just the same as the coupon rate, but there's a difference, and I will show you the difference in a moment. It's important to know the difference. The other term I just like to bring quickly are maturity date. The maturity date is the date at which the issuer will repay the investment that you put in, will repay the principal. And the term is the period between the issue date of the bond and the maturity date of the bond. That's when we say the term of a bond. So if you have a 10-year bond, the term is 10 years. A 5-year bond, the term is 5 years. The difference between the issue date today and 5 years later when it will be repaid. So I said I will speak about the difference between the coupon rate or the stated interest rate and the rate of return to you, which is not always the same. And for this, I will try to give an example of it. Maybe we can do an example on the board, and that's it. Let's take a banking example, because this is the Caribbean Association of Banks webinar. And let's take an example. Let's say, for example, I want to invest in a CD. And let's say this CD they gave me is a CD to be 1 year, a 1 year CD. And this 1 year CD, let's suppose they give it to us at 2.75%. And this 1 year CD, 2.75%, I got it to be bought. I have $1,000 worth in that, so I bought it at $1,000. Right? So with this investment, with this feature, 1 year, I'm actually expecting to get back in 1 year my return. So I will get back at maturity. At maturity, I will get back my original amount, what we call a principal. And that original amount is indeed the $1,000. And I will get back interest. The interest I will get back is the interest on the 1,000. So the interest on the 1,000 is not too hard at all. It is the 2.75% of 1,000, and this works out to $27.50. This is what I will get back in interest, $27.50. And this interest I will get back means that at the end of 1 year, my investment has given me a total of, in dollar terms, $1,027.50, and this $1,027.50 I get back when the year is finished and my maturity is finished. What this means is that I have a yield, which is, the way I work out my yield is that amount that I get back. So I put in 1,000, I get back 1,200. My gain on this was $27.50. So this $27.50, I work it out as a percentage of 1,000, right? And $27.50 as a percentage of 1,000 is actually bringing us to the point where and this is actually going to work out for us to 2.75%. This means my return is 2.75%. My return in percentage is 2.75. So what we are seeing here is, in this case, the coupon rate or the stated interest rate on the CD is the same as my return or the yield, right? But let us change this up a little bit. Let us say, for example, I bought this same investment. I bought the same investment the second year, and what happened in this investment is that during the year I actually bought it and I paid $1,000 for it. But during the year, that 1,000 that I had there, some financial hardship came about and I had to break it, right? And then when I had to break this thing, it means that it will hurt my rate of return. Here is how it hurts the rate of return. They put a penalty on me for taking it back too early or interfering with it before it matures. And suppose that penalty works out to about $25. What that means is that when it is time to pay me back at maturity, this penalty, which is $25, reduces what I will get back from 1,000 to $975. See, that's what I will get back, $975. So it means that this time I'm getting back $975. Will I get back the interest? Yes. The rate of interest has not changed, and the CD is still a $1,000 CD. So I will get back $27.50 as a return on the interest on my CD. But what happened in this case is that when we look, what is the total amount of money I'm getting at maturity? The penalty was taken out, so I got only this. So the total amount is no longer $1,027. It's actually the $975 plus the $27.50. And what that works out to for us is $1,002.50. Now, I have received this. It means I'm ready to work in my yield. What is really my yield? I actually just have only $2.50. But remember, I paid $1,000 CD. So the return on it ends up being $2.50, right, on my 1,000. And this time, what my rate of return is only, you just work this out, is only 0.25%. You see what this means? What it actually means is that my rate of return, my yield, my rate which was quoted is still 2.75, so I still got that, but my yield, the sense that it makes to me, the value of this investment to me, has been reduced to, in this case, 0.25%. That's what we mean that the yield is different from the interest rate. And so we find a lot of people in investment don't really check this, don't really realize that this is a problem. So 0.25%. Don't realize that this is a difference and this is a problem. So you find that a lot of persons end up with a coupon, with an investment, even in a bond. And I am advising you that a bond is good for retirement investment. And I don't want a broker to bring to you an investment, give you what the coupon rate is, and don't work out for you what the yield is. So the annual rate of return to you is what is important when you do investing for retirement. Extremely, extremely important. We cannot stress that too much. I mean, it's so very important that we spend time on it and we take a moment to show it happen. For those who are accustomed with it, it means that you just apply that same principle to bonds, because the bonds actually operate in the same way. If what you pay is, if what you get back is less than the coupon rate, it means that you actually have a yield which is lower than the actual rate of return on the investment that you have put in, right? So in this case, in the example that I showed you, it means that the coupon rate remains 2.75%, but the yield to you in that case is 0.25%. This is a nuance that's extremely important, and we give it in this webinar so that you be aware of it when you are doing your investment. More than likely you are doing self-investment or through your broker. Either ways, you need that information. Bonds are typically considered as being conservative, more conservative than stocks and shares for the reason we mentioned earlier. You have a promise that you will be repaid, you have an interest rate fixed at which you will be repaid, except as variable bonds, but we hardly do variable bonds for retirement. And the entity, though, that is issuing the bond may or may not be able to pay you back. So that means that the bond has the risk of default as well. And if the entity is not able to pay you back, that's a problem for your retirement monies. And so you want to be able, whether government or corporate, it doesn't matter. We need to know what is happening with them. And so how do you determine the risk profile of an issuer or an investment that you are entering into? Especially you want to make sure you protect your retirement and you go into investment in a knowing way. How do you do that? The way you do that is to determine how much risk a bond has by looking at its term of duration and also by looking at the credit rating of the issuer. So let's take each of these in stages. Duration of term. Now the shorter term bonds will have less risk generally. For example, if I bet that Grace Kennedy or St. Lucia Electricity Services Limited will be in business next month, we almost sure that that will happen. And so since we all know that that will probably be the case, we are able to say that there is not much risk that an investment in them would go bad, right? If they issue bonds, because not all companies issue bonds. What about the long term? Longer term bonds have higher risk. Now, I think that if I say I think that Grace Kennedy and Lucy Lett will still be in business 30 years from today, how much certainty do I have of that? Not much. And so due to the increased uncertainty, longer term bonds have more risk than shorter term bonds. So you need to look at what they call the yield curve, which your broker will help you with. But the point of the matter is that you need to have an appreciation for the difference and be able to look and see where you are in, long or short, high or lower risk. Think of a company, any company that you know that went out of business in the last period, anybody you know, and tell me whether or not 10 or 5 years before they went out of business, you could have predicted that. Usually, it would have been difficult. The great American companies, Bear Stearns and Lehman Brothers, no one knew 5 or 10 years before they went into problems that they would go into problems. They were so strong, they were among the too big to fail. So this is duration of the bonds. Now we look at the credit profile from the credit rating point of view. How do we know and are able to check that out, both for government issued bonds? Government issued bonds are considered of the lowest risk, and government backed bonds as well. The corporate bonds are not guaranteed, and so some of them will be backed by collateral, so they will be fairly safe in that sense. But you will still be looking to know what are their risk profile. Now, issuers of bonds and their bonds themselves are rated by highly qualified, highly professional, independent specialist rating agencies such as Moody's, S&P, Fitch, Caricris. We take a look at the Caricris people because they are in our region, and that agency does some very sound and very good work. For example, they say in their manifesto that for borrowers Our ratings will ensure credibility and expand access to funding sources. That's a statement they make. And the reason why they make that is that they are telling us that they give independent assessment. And we will be able to know from what they say whether a company's risk profile is high or is low. I take a moment, let me see if I can show one of the reports of CARICRIS. There's a recent report of CARICRIS. I think it's on the screen. I believe you should be able to see it now. And this report is for the quarter April to June. And in this report, CARICRIS gives objectives. Here, for example, they tell us about COVID economic effects will be severe. So they give us an economic analysis to say what COVID will all be affecting in the island's economies, what we expect to see. And they give assessment of companies. For example, NCB Global Finance Limited, they assess them. Here they can say their TT currency exposure rating is TTA. They have a CARICRIS A rating in their foreign currency. Let's see some other people. Goddard Enterprises, they have Goddard Enterprises. So they assess companies, and you can go to CARICRIS's reports, whether in the media or directly to them, and you can find what is the risk rating. Here they say this is good. The government of Dominica, they assess the government of Dominica. They give them a CARIC BBB, double B, and here they have someone else. So you see, this is I'm just trying to demonstrate that we have a place where we can find, without much ado, without even going to a broker, what the information or what the rating on companies are. And so you want to have that when you invest for retirement. Any investment that is higher than or triple B or higher is considered investment grade. Triple B or higher, investment grade. Things lower than triple B, for example, double B is considered high yield bonds. Well, it's high yield because it's also high risk. This type of bonds from BB, go down and so on, they're called junk bonds. And you can invest in them depending on your investment horizon, especially if it's long. And if you really can afford to lose that money, you will get higher rates if they do repay. But this is a way in which you assess whether or not you should be in that type of bonds. Again, your specific recommendations will come through your broker. So what we see is that using the duration of bonds and using the credit ratings, short-term bonds 0 to 5 years, intermediate bonds 5 to 10 years, greater than that over another 10 years. And what we find is that longer-term bonds may involve higher risk, and usually, therefore, they have higher rates of interest offered on them. Do not be fooled just by the interest, look at other factors as well. Lower credit rating involves higher risk, and they offer, therefore, higher rates in order to interest people to come to them. Higher credit ratings, there, are good, because they involve lower risk. It means that CARICRIS has said that is a lower risk, I give them a higher rating. And so they do not necessarily have to give any high rates to you to attract the investors, but they might be pretty sound and ready for those of us who are investing for retirement. This, my friends, is an illustration of all that I've been saying. You can see here, bonds, this is credit rating down here, that have high credit rating and have short terms, usually have lower risk, and they have lower interest rate offered, but they are stable for you. Bonds that have low credit rating, on the other hand, and bonds that are longer in their term to maturity, they tend to have a high risk profile, and they also offer higher interest rate to attract investors to it. So these are things that we be aware of and be careful about in the risk profile of company. So coming back to this point of the coupon rates and the rate of return to us as investors being different, right? We could look at and see at what's the difference. The difference is whether you are buying at par, that means you'll get back exactly what the coupon rate is, or you are buying at a premium, which means that you are going to get back, you are going to actually buy a bond for more than the coupon is, or you are buying at a discount, so you are paying less for the bond, right? So I'll just suffice it to say easily that interest rates affect bond prices, because when interest rates go down, a bond that was bought before the interest rate went down, the price of it will rise. Why? Because in order for somebody to get that bond from you, when interest rates are going down, they will have to pay you a premium. They will have to actually pay you more, so your bond price rises. Conversely, if you bought a bond today and the interest rate on new bonds that are being issued went up, it means that nobody would want to buy your bond because you bought it, let's say you bought it yesterday at 2%, and right now somebody could go to the market and get a new bond at 3%, they wouldn't want to buy yours. So your price to get rid of your bond will fall, right? And so this you have to be careful about, that bond price and bond interest rate work in opposite direction. This graph is actually saying that. And repeating on this slide what I said, the par, the premium, and the discount, we'll be familiar with that. When interest rates go down, bond prices go up. Don't pay or don't sell your bond for less or for par if interest rates are going down. Sell it for premium, it should go up, right? So this inverse relationship you must be familiar with, and we just give it as part of the awareness so that you know. The yield is important, and we keep saying be sure that you're paying attention to what a bond yield is. The bond yield is the rate of return to you. It is not the coupon rate. And for this, I would like to go to the board, but I think I lost some time earlier on. So let me just try to show it. Let me pull in a slide here that will show it. The way you know what your yield is, you use a very simple formula. You can write this one down as well. The interest that you collect, which is the coupon rate, whatever the stated interest rate is, the actual, in our earlier example, the actual $27.50, divided by the market price. So the market price will be what is the bond selling for right now. That tells you what your yield is. I know a lot of professionals even find difficulty in this. And here's an example that I put on the screen. If I bought a bond at par, $1,000 for it, I paid $1,000 as the price today. The interest on a bond is 5%, I will get back $5. At par, it means the yield to me, what this really is, the value to me is 5%. But if I went and I paid $900 for it, that means I bought it as a discount. So I buy a $1,000 bond at a $900. What I put out is $900. $50, which is the interest I receive at the end of the year, divided by 900 means that my yield is 5.5%, even though the $1,000 bond's interest rate is $50. And similarly, at a premium, if I went and paid $1,100 for a $1,000 par bond, I'm still getting back the rate of $50 because the interest rate does not change. And so my yield will be less than the 5% because I paid more for the bond than its par value. These are the things that you want to be aware of. Now, how do we really pay attention and take advantage of this information that we keep giving in these webinars and these information packages and brochures and awareness seminars? How do we really make sure that our retirement monies or retirement for investment are in fact protected? How? That's the question. Well, one of the things we do is the reason why we offer the full workshop on retirement planning, because in that workshop, which is called Immediate Changes One Must Make Now to Have Money After Retirement, that title is the theme of what we do. We look into everything. We work with you on your pension plan contribution, your credit union share, your retirement savings, what they are, what they should be, what your retirement income should be. And we have this workshop in 5 parts. The first part, we look at your readiness. We work with you to show you in your foundation where you are and to discuss with you so that we help you to establish exactly where you are at this time in terms of retirement. In part 2, we look at your priorities. We say, what are you doing now? How are you spending? What is your investment in the market or your investment out of the market? How prepared are you to withstand shocks? And whether or not you have readiness to go into investment. Have you saved enough? Is your emergency fund substantial enough? We look at all of that and we set your priorities straight. What about preparing for your kids' education and all of that? In part 3, we look at specifically at home equity, home purchase. We look and see how much your mortgage is, or whether you're renting and what the value of renting is, the difference between renting and buying for your personal situation. We walk through all of that. And we even look at some advantages you can take of COVID relief funding and so on from NGOs and from government to see how you can use those to help you increase your savings and even increase your investment for retirement. In part 4, we look at your retirement savings in general. We make sure we finalize your number in a way that you yourself are comfortable. Shows you how you will be when you are in your 10th year in retirement or so. We put it down in checklists and in templates and so on, and you walk them through. Very easy, not very difficult, but the point is how to walk through them, and we show you. And finally, in part 5, we walk through how you will do your investments. So much of what we've done about bonds today and about risk tolerance and time horizon, we put that into your specific situation as we walk through that part 5 of the workshop. This workshop is a good one for persons who are not really there yet with a full plan, or who doesn't have a clear plan and would like to get assistance in working through their own situation. What happens when we do not pay attention to our retirement planning? Well, to put it directly, we could end up broke with little money to pay our bills and with little spending money for entertainment, for vacations, and so on, and even for shopping. And we find that some of us will get into retirement and realize that medical emergencies are greater than we anticipated. We are unable to cope, and sometimes we are not well, so we are unable to work. Other persons will just find that they outlived the money that they had saved or put aside, or that they got from their employer pension plan. And so we want to make sure that that doesn't happen to you. We want to make sure that you look at all the elements in our 5-part workshop, and we offer this to you today. Immediate changes one must make now to have money after retirement. We go through each part quietly. We go through each part deliberately with you. We dedicate about 2 hours to each part, and we work through until you are satisfied as a course. It is not a securities investment machine, but it's just a course. And at the end of the course, you get your lectures, you get your text files, you get even your worksheets and templates, so that you don't have to go back to any advisor or anyone. You can walk through with a checklist that we provide to you. Here is my offer to you for the course. The course, which normally goes in the academy at US $900, I'm offering it to you on this webinar for $497. Yes, we offer it to you today, and it is open for 3 days. $497. It's on the internet already. You can jump onto the internet and you can register right there. $497 for the full course, and for all of the materials that comes out of the course, and for your own retirement plan figures in there, in the materials and the templates. So you can jump over. This is the website right here when we are finished, and you can, but wait, don't go yet, because I have an additional item for you. I'll give you a special bonus. It's valued at $500, but it's yours free if you register for the workshop today. The offer is open for 3 days, so if you register within the next 3 days, it expires in 3 days, you will indeed be able to get this bonus. And what is it? Registering the full course today or in the next 3 days, $497 you pay, and you get a free bonus 60-minute one-on-one call with me, so I can personally review with you your retirement plan. Or if you do not yet have a retirement plan, a clear one, we will review your situation, your own personal situation, look through your nitty-gritties, and we can come up with some initial steps. We can do that together. So this is my offer to you, and it is indeed a nice offer. It's $497 for the full course, and in addition to that, you get a one-on-one consultation with me. This is the website. In case you cannot remember this website or didn't write it down, you can just go to my own website, tarliefrancis.com, and that you will be directed from there to the registration page under the tab Retirement Planning. So either you go to tarliefrancis.com, finishing this webinar, or you go to this website right here, and you can enjoy this offer. You can go to tarliefrancis.com. I want to thank you so very much for being with us this evening. I wanted to thank you for sharing with me this time, your precious time, and also to thank the Caribbean Association of Banks, and you, especially Brother Terry, for working things out so that we can have this webinar this evening. Thank you all very much, and I look forward to hearing of your success in retirement planning in general and in investing for retirement. Feel free to reach out to me at any time. Terry, back to you.
Ali, just before we close out, we have a couple of questions. Thank you so much. Some great content there. I think we just have about 3 or 4 questions, so we'll just pop to those right away in the Q&A. Can you please elaborate on your suggestion to hold less cash? Because in retirement years, cash is what is needed for bills, healthcare, enjoyment, etc. It would be hard to have assets such as land and no cash to help you live a decent life.
Wonderful, wonderful. This question is so great, and that is why retirement planning is extremely important. Remember, when you have cash, what you actually have is the dollars liquid. Your rate of return on your savings accounts are usually lower than what the rate of inflation is. You don't want to have $1 million or $800,000 or even $500,000 or $300,000 just sitting around there waiting for you to get from 65 years to 66 years to 67 years, and you are spending like that. That money should be working for you even while you are in retirement. That's extremely important. I said that I'm retired early. If I do not have some form of investment working for me at the same time, but I have all my money in Bank X or Bank Z, what is happening there is that for every year that my money is kept in Bank Z, it means that the buying power of that money is falling. And one day, I will be looking for that money, because in addition to the buying power not keeping at pace with inflation, the cost of maintaining my cash accounts are becoming more and more with charges and fees expensive, and everyone in our region knows how that is an issue these days. But the full retirement planning exercise that you will do, whether with me or with anyone else, will now ladder or segment. It will put a pie of all your assets in such a way that you have your emergency funds, because that must be liquid and in cash. But you have other assets, whether in investments like retirement, bonds that you buy to put in your retirement fund. So your retirement account would include some stocks, perhaps some bonds, perhaps some rental property even that you have that is bringing in rental income. Rather than having the cash for a condo, you have the condo itself, and that condo is bringing in rental income. But you should have planned from years like now to have the money invested in the condo with maintenance and everything also worked into your planning so that it will be an income stream. In retirement, what we need is a cash flow in. One of the things that gives us a cash flow in is the investments we have made with money that we earned during our accumulation years, as they call it. So that's a wonderful question. And what it is asking me is, I am afraid I will not have the money. I need to have that money. But if you, one very good text to read is a text called Rich Dad, Poor Dad by Robert Kiyosaki. I speak about that in another webinar. What that tells us is that you need to have money not there, accessible to you, but flowing into you in the time that you need it. For that to happen, that money must be in the productive sector somewhere, making money, not in the lazy or in the inactive sector. Just wait for you to pick it up. Thank you.
Another question, how can a person who earns enough to live day by day save for retirement?
This is another question which is so important. Again, everything depends on your specific situation. Every single thing depends on your personal situation. That's why it's good to work out your math for yourself, your age, your number of kids, etc. But two principles here are important. One principle is if you are living paycheck by paycheck, that is already a problem. It means that your expenses are here and your income is here. Usually, it is easier to adjust your expenses. You need to adjust your expenses down because that's what you can control. That's the first principle. The second principle is the question of paying yourself first. We always hear that in most of these seminars, and in the textbook, you find them as well on personal finance. This is extremely important. Pay yourself first means that if you are actually having the life, the energy, the intelligence to work now for $5,000, what is so hard to put aside 10% of that? Spend less on things like a bare money, spend less on things like the amount of electricity that you are consuming, do less AC in the house, use the washing machine less, etc. Sacrifices like these. Live in a different area, for example, rather than trying to live where the Joneses are, things like that. But those are things that we work through personally. But the point of the two principles are that really and truly, I say starting principle because there's so many, is that you have to ensure that whatever you're working for now, don't keep yourself in a paycheck to paycheck grind that you can't see your way. Because it means that you are not putting aside any money at all to be able to one day use that money to be generating increased savings and be generating increased investment. One of the things we do in the full workshop is that we help people see where you have money wasted right now that you can use to increase savings or to increase investment.
One more question, Tarlie, before we close out. What are your thoughts on taking a loan for investment purposes?
Right. If the lending environment or the borrowing environment for you as an investor is where rates are very low, in a growing economy, in a thriving sector that you are seeing the rate of return is high, it means that you are actually taking money at rates that are sufficiently low to pay back the loan on that money you need to take an investment where the return is high. What is important here is the yield as well. That's why I stress so much about yield. For example, if you took money to buy a rental property with an investment loan, you were able to get that from your bank, and it was at 4%. And it was at 4%, and that is fixed for you for, let's say, 10 years. And you have worked out that the place you can get that investment, the location, allows you rental to give you back a yield on the investment in the property of, say, even 6%, even a 2% percentage difference is important, or percentage yield is important. Then every month people are paying that mortgage for you. Those who are paying the rent are paying the mortgage for you. Such an investment is okay. If it is uncertain, don't take it. If you can't afford to really find the money to pay during 1 or 2 months because you have no provision for that, don't take it either. You only take it when you can afford to pay based on the rate of return from the investment, based on the analysis of the investment compared to the low rate borrowing environment that you're in, or maybe your credit worthiness is so good that the bank would lend you at low rates. And so large companies do that quite a lot. And so that's why you find a lot of companies not even on the stock exchange. They don't need to go to the public for money because their credit rating is so good. The banks are running after them to give them money at fairly low rate. That happens to other individuals as well. So that answers the question, saying that you can take it only where it makes financial or rate of return and yield sense.
All right. Thanks a lot, Tarlie. And Tarlie, thank you so much for doing this with us. Of course, we have a number of other financial literacy resources on our website, on our social media, on our Facebook page, our Twitter, and our YouTube. In fact, I just posted in the chat. If you want to check that out, folks, you can look for some further perspectives on investing with our podcast, Know Your Net Worth, Managing Your Assets and Liabilities. That's on the Caribbean Association of Banks YouTube page. And Tarlie, I'm sure you'll want to take that in as well. And that included Charmaine Francois, who is at NCB Anguilla, whom I'm sure you know, formerly at Bank of Montserrat. Our chairperson, Dalton Lee, who's an accountant and a very successful businessman in his own right, and also Ryan Weber from Raymond James. So we had that discussion last month, and I think it was very, very enriching. And it sort of bookends some of what you said. It offers a little bit of a different perspective, but also it reinforces a number of the key points that you made about some of the tips and tricks that one needs to be aware of in terms of looking at the right investments. So once again, thank you so much, Tarlie. This has been invaluable. And unfortunately, the Facebook wasn't quite working out, but we do have this recorded. So we will be posting this as well to our social media, so folks can go ahead and check this out. And we do have some further discussions coming up in the next week or so. Stay tuned to our social media for those.
Thank you very much, Terry, and I commend you and your team for the excellent work you're doing in financial and investment management awareness. Personal, that is important because this is critical for us in this region right now, that these things become things at the fingertips and second nature among our people. Thank you very much.
Absolutely. Thank you very much, Tarlie. Thank you very much, everyone, for joining us this evening. We do appreciate it, and we look forward to welcoming you as guests for further interventions in the not too distant future. Have a good weekend.